Welcome to the Crypto Futures Bible Guide. In this comprehensive video, we'll delve into the world of cryptocurrency futures, exploring how you can navigate this dynamic market to minimize losses, maximize your outcomes, and make informed investment decisions. Whether you're a seasoned trader or just starting, understanding crypto futures is crucial for strategic investment. At its core, a crypto future is a financial contract allowing you to speculate on the future price of a cryptocurrency, like Bitcoin or Ethereum, without actually owning the digital asset itself. It's an agreement to buy or sell a specific crypto at a predetermined price on a future date. Unlike direct crypto ownership, futures trading is about predicting price movements. These contracts are standardized and traded on exchanges, much like traditional futures. You're not buying the crypto, but rather betting on whether its price will rise or fall. This allows traders to profit from both upward movements, by going long, and downward movements, by going short. However, incorrect predictions can lead to significant losses, especially given the inherent volatility of the crypto market. Crypto futures serve two primary purposes: speculation and hedging. Speculation is about capitalizing on the rapid price swings influenced by market sentiment, regulatory news, and global economic conditions. Hedging, on the other hand, is used by businesses and institutional investors to mitigate risk. For instance, a company holding Bitcoin might sell futures to lock in a price and protect against potential declines. While offering significant potential, crypto futures trading carries substantial risks. The market's unpredictable nature and high volatility can lead to sharp, sudden swings. Leverage, often used in futures trading, amplifies both gains and losses, making robust risk management absolutely critical. The CME Group offers various types of contracts, including standard and micro futures, the latter being more accessible for those with lower risk tolerance. Effective risk management is the bedrock of successful crypto futures trading. It's a disciplined approach designed to protect your capital, reduce emotional decision-making, and promote consistent trading performance. Without a solid plan, you expose yourself to significant financial losses. Let's explore key strategies. First, diversification, spreading your investments across different assets to reduce the impact of any single asset's poor performance. This could mean diversifying across various cryptocurrencies or even other asset classes. Second, position sizing, carefully determining the size of each trade. A common rule is to never risk more than 1 to 2% of your total capital on a single trade, adjusting based on volatility. Third, stop-loss orders, a crucial tool that automatically sells an asset when it reaches a predetermined price, limiting potential losses. Fourth, take profit orders. These secure your gains by automatically selling when a profit target is met, preventing you from holding onto winning positions for too long. Fifth, leverage management. While leverage amplifies gains, it also magnifies losses. Start with lower leverage and increase gradually, always using stop-loss orders. Finally, regular monitoring and rebalancing, continuously reviewing your portfolio and adjusting allocations to align with your risk tolerance and evolving market conditions. This proactive approach ensures your strategy remains effective in a dynamic market. Technical analysis is a method to forecast future price movements by studying past market data, primarily price and volume. Unlike fundamental analysis, which focuses on intrinsic value, technical analysis seeks patterns and trends to identify trading opportunities. Key aspects include chart patterns, such as head and shoulders or triangles, which can signal potential reversals or continuations. Indicators are mathematical calculations that predict price changes. These include moving averages, price data to identify trends, the Relative Strength Index, or RSI, a momentum oscillator indicating overbought or oversold conditions, MACD, showing the relationship between moving averages, and Bollinger Bands, which help identify volatility and potential reversals. Understanding support and resistance levels is also vital. These are price points where an asset tends to stop and reverse. Support is where buying interest is strong, preventing further falls, while resistance is where selling pressure prevents further rises. Lastly, volume analysis confirms trends, with high volume often indicating stronger conviction behind a price move. Successful crypto futures trading combines well-defined strategies with astute market analysis. Let's explore some effective approaches. Trend following aims to profit by identifying and riding sustained price movements. If a short-term moving average crosses above a long-term one, it might signal an uptrend, prompting a long position. Range trading is effective in sideways markets. Here, you identify assets trading within a defined price range, buying at support and selling at resistance. Stop-loss orders are crucial just outside the range to manage risk if a breakout occurs. Breakout strategies involve entering a trade when the price moves outside a defined range or pattern, expecting continued movement in that direction. Look for high trading volume to confirm genuine breakouts and avoid fakeouts. Arbitrage exploits temporary price differences for the same asset across different exchanges. This low-risk strategy involves simultaneously buying where it's cheaper and selling where it's more expensive. While generally safe, it requires extremely fast execution. Finally, news-based trading involves making decisions based on significant news events. This high-risk, high-reward strategy requires close monitoring of news sources and anticipating market reactions. However, it can lead to substantial profits if executed correctly. Beyond specific strategies, a disciplined approach to risk management and continuous learning are crucial. Advanced techniques include correlation analysis, understanding how different assets move in relation to each other, and volatility management, adjusting position sizes based on market volatility. Stress testing involves simulating extreme market conditions to identify vulnerabilities in your strategy. And hedging with options can provide flexible risk management, limiting downside while retaining upside potential. Psychological discipline is paramount. Emotions like fear, greed, and overconfidence can lead to irrational decisions. Develop a clear trading plan and stick to it. Avoid overtrading, patience is key. Manage your emotions, and regularly review your trades to learn and refine your strategies. Continuous learning and adaptation are vital. Stay informed about new technologies and regulatory changes. Backtest your strategies on historical data before risking real capital, and be prepared to adapt your strategies as market conditions evolve. Making informed trading decisions requires a systematic approach to market analysis and timing. Our market analysis framework includes macroeconomic analysis, understanding broader economic trends, on-chain analysis, examining blockchain data for network health and adoption, sentiment analysis, gauging market mood, and intermarket analysis, observing relationships between different asset classes. For timing strategies, always wait for confirmation of a trend or pattern. Look for retests of broken support or resistance levels for lower risk entries. Understand volatility cycles to adjust your trading style, and use multiple timeframes for a comprehensive view. Consider event-driven trading around significant scheduled events, though this carries higher risk. Before any trade, use a decision-making checklist. Do you have a clear strategy? Is the risk-reward ratio favorable? Are market conditions suitable? Have you received sufficient confirmation? And most importantly, are you making this decision based on logic, not emotion? In conclusion, successful crypto futures trading is a journey that demands a balanced approach. Prioritize risk management, protect your capital, and continuously educate yourself. Utilize technical analysis and well-defined strategies, but always remember the critical role of psychological discipline. By combining knowledge, discipline, and continuous learning, you can navigate the complexities of the crypto futures market with greater confidence, minimize your losses, and maximize your potential for success. Thank you for joining our channel on this guide and stay tuned for more.